Hi, this is Ollie and welcome back to Make Money Trading. And this is a broadcast session that I'm recording on the 4th of June 2020. That's of course New Zealand time, so if you're in the US it's probably still the 3rd of June, or the Europe or England. And this session is about how to play 2020 in the markets. Part 1. I'm going to do at least one more part, maybe two, on this series. So as always, I have to separate myself from what I expect should be happening in the market to what is actually happening in the markets. Now, I personally think that the equity markets are ignoring a number of key fundamentals: soaring unemployment, soaring national debt, significant earnings drop due to COVID-19, restricted travel, and a huge earnings shock to travel, tourism, and related companies, and of course the ongoing uncertainty in relation to health and travel, etc. However, the market does not care what I think. I have to be very careful that I separate away what I think from what the market is doing, because the market doesn't care what I think, it doesn't do what I think. Even though I've been trading the markets for 30 years, it still doesn't do what I think it's going to do. So therefore, I must look at prices and charts, because that tells me what is actually happening in the markets. And I look at over 100 instruments, over 100 different instruments regularly, and they are made up of currencies, commodities, stock indexes, and individual stocks. And the reason that I do that is something very fundamental, which I'm about to tell you about. That's why I've got on this the last sentence here: let me tell you something worth more than $1 billion, because if you really grasp this next slide, then you're on your way to making your first $1 billion, billion with a B. And here it is. A key truth is this: hedge funds, insurance companies, mutual funds, countries, companies, and all investors are always trying to find one thing: the highest return for the lowest risk. And this is what drives global fund flows. So I know that sounds incredibly simple, but any time you go to the markets and you see oil going up, gold going down, the pound going up, the Nasdaq going down, the Dow going up, whatever you can think of, stock, index, commodity, the only reason they are going up and down is because all financial instruments are driven by supply and demand, and they're driven by the supply and demand for money, and that money is driven into and out of all of those financial instruments because of this one thing: trying to seek the highest return for the lowest risk. So if you see equities going up like they have in the last month, you know that the majority of people who have money to spend, and we're talking about, that's why I've said hedge funds, insurance companies, mutual funds, countries and companies, we're talking of organizations that literally between them have trillions of dollars, trillions with a T, to move around trying to find the highest return for the lowest risk. So that's why when you see equities moving up like they have in the last 3 or 4 weeks, it is because the majority of the people controlling the money believe that the highest return right now for the lowest risk is in equities. If they thought it was in oil, they'd be moving their money into oil. If they thought it was moving it into a particular currency or wheat or soybeans or whatever, they'd be doing that. And that's why I look at over 100 different financial instruments, because I want to see what money is flowing where. And the other reason why this is $1 billion slide is because if you can sense and see early when money is flowing into financial instruments, then you can get in early and be the smart money and then you can make money from all of the other people who come later, the trend traders and the followers, etc. And the opposite is also true: when you sense and see that money is starting to flow out of something where money has flowed into it for some time, then you can be the person who exits early and doesn't get hurt on the other side. So again, if you understand this slide and you are able to watch and see when money is flowing into and out of any particular financial instrument. And by the way, I'm including things like real estate or any other investment you might see, although of course in this course we're talking about the financial markets. But I've personally made an awful lot of money moving into and out of the real estate market when I can see that fund flows are going into the real estate market because people think that real estate is the highest risk for the highest return for the lowest risk. So yes, I would copy this and put it on your wall or put it in your diary or somewhere, because if you really understand global fund flows, you can get in early, ride the wave, get out early because funds are flowing out, then you are on your way to your first $1 billion with a B. And of course, that is exactly what I've said. That is what is currently driving equity prices higher. Now, why particularly are equity prices going up? Because of this global fund flow? Well, here is why. Governments around the world, led by the US, are pumping trillions of dollars, literally trillions, into the world to stimulate their economies. And that money has to go somewhere, i.e. it is searching for the highest return for the least risk. That's the first part. And second part, interest rates have been smashed lower in the last couple of months, and let's see why that is so important. Sorry, that should say why, not what. Let's see why that is so important. Okay, so the benefits of low interest rates to a company. The company itself can refinance existing loans at a lower rate, which means less interest expense, which if you remember basic accounting, automatically means higher net income, which of course means higher earnings, and stocks in general are valued based on earnings. So immediately they get a hit to their bottom line, positive hit to their bottom line, increase earnings, number one. Number two, the company can borrow new money cheaply to buy new assets, expand their business, make acquisitions, etc. So not only can they refix existing loans, but they can go and get new loans at ultra low rates. You might have seen in the news in the last couple of days, Amazon has just borrowed $10 billion, 10 billion with a B, at the interest rate of 0.4%. So less than 0.5% Amazon is borrowing, and that is a massive benefit because, of course, Amazon is going to earn a way greater return on that money than 0.4%. They've got this wonderful benefit of borrowing incredibly cheaply to fund their business and make a huge amount more than 0.4%. Hey, even if they make a 5 or 6% return on something that's costing them 0.4%, they are making more than a 10 times return on that borrowing. So, number two reason. Number three, investors are less likely to leave their money in the bank or put their money into bonds or put their money into other things actually, because the returns are so low. So investors like you and me, but more importantly the fund managers who are controlling billions of dollars, they are taking their money out of fixed interest and they're looking for a home, and one of the homes they find is equities. So as I say in the second part, investors are incentivized to buy stocks, and then after them come the trend traders and the momentum traders, etc., and that causes stocks to go up even further and faster. And number four, people like you and me, just normal general citizens, we borrow money to buy things because interest rates are so cheap. We've always wanted to buy a boat. Well, our $30,000 boat that we could never afford before, now that we can borrow at 1.5%, it suddenly seems cheaper. Or we want to buy a holiday house, or we want to sell our house and buy one that's twice as expensive, or we want to buy a new lawnmower, or a camper van, or a new bike, or whatever we want to buy. Suddenly we can buy it way cheaper than before. And of course, anything that we buy benefits the companies that make those products. So there's this sort of virtuous circle of lowering interest rates causing money to be borrowed and then plunged back into the economy, which benefits companies over and over and over again in 4 different ways, as we've seen. So there is a quadruple whammy of benefits when a government reduces interest rates. And since March of this year, interest rates have been crushed, which is why stocks and other risk assets have been climbing. Okay, so we do, however, have a very interesting dynamic in the market. We've got a tug of war between, number one, the fundamental risks of unemployment, debt, falling earnings, restricted travel, huge earnings shocks to travel, tourism and related companies, and uncertainty, all related to COVID-19. There's a tug of war between that and what we've just talked about. The bottom sentence here, the fund flows into equities because of economic stimulus and low interest rates. So it's not one-way traffic. Just because interest rates come down doesn't automatically mean that equities are going to go up. There is this tug of war, especially right now, because we've got these two opposing forces. But of course, right now, as of the 4th of June 2020, the equity bulls are winning that tug of war. And I determine this by looking at prices and charts and not by looking at news headlines. I don't care what news headlines think. Most of the time, business reporters have to report something. The market's gone up, they have to say why. Market's gone down, they have to say why. Most of the time, they have no clue why it's gone up or down, but they have to say something. You often see market commentators say, oh, the market's down on profit taking. Well, who knows whether that's true or not? They don't know. They're not canvassing everybody who decided to take profits. They just make stuff up. So I don't look at news headlines. What I do is I look at over 100 financial instruments, and they are telling me that the equity bulls are currently in control. Okay, let me show you a couple of things that I'm looking at. Right, one of the pieces of analysis I've done in the last few weeks is this, and I've looked at the major stock indexes from around the world, not all of them, but a good number of them. As you can see, there's about 15 of them here. And I have looked at the 2020 high in these markets. So that high was put in, you might remember, most of these the high was in February. A few of them would be in January. Most of them, the high was in February, before the market really started turning down on or around the 21st of February. That's when the market started falling. So I've looked at the high price. And then I've looked at the price as of yesterday. I did this analysis yesterday, 3rd of June 2020. And then by finding those two figures, I can find a percentage of the current fall from the high. So right now, as of yesterday, the Spanish market is down nearly 27% from its high. Italy's down over 25%. You can see all the way down. I've ranked them in order. And I've put these that are more than 12% in bold down, and I've put these in green that are less than 10%, and I've put the lovely NASDAQ in green down here because compared to its 2020 high, it has, and its current price, it has actually fallen the least since compared to its 2020 high. In fact, it's almost at new highs for the year, only 0.81%. So if things keep going, in the next couple of days, could even be this week or next week, if things keep going the same way, the NASDAQ is going to go to a new high for the year. So that tells me what the equity markets have done in terms of comparison to the 2020 high, because I want to see which ones are doing better than others. Of course, NASDAQ is doing the best. Japan isn't far behind. China not too far behind that either. So that's the first piece of analysis that I do. Okay, so I already knew, of course, that stock prices had been smashed in March, late February, March, with the COVID-19 pandemic. And then, of course, as I've just showed you, of all the equity markets I looked at, and they're all the major ones, the NASDAQ was the strongest. And that was, of course, confirmed by the NASDAQ chart. Let me show you that NASDAQ chart, and I'll show you what I mean. Okay, so here is a current up-to-the-minute chart of the NASDAQ. And as you can see, I've got one of my favorite indicators. I'm on the daily chart, 1D for 1 day, and I've got these two moving averages, the 10 and 30 period simple moving average. So as you can see in the run up, and this chart goes from October 2019, in the run up at the end of last year, let's have a bit more of a detailed view. You can see that price came in to what I call the moving average buy zone and was a buy here, came back in here, was another buy, came back in here, was another buy, and any time you had bought that, and I do talk about this in other places in the course, but briefly, you wait for a candle and then wait for a break up the next day, and you take the trade as it breaks up and you hold it, and you just keep holding it, especially until you get, usually I would use a 10-day low, a new 10-day low. So actually you are using a 10-day low, you probably would have sold out there. And then you would have re-entered about there because you wait for a candle and then a break above the candle. The other thing is you can just use these moving average lines, so you could have got in there and been holding all the way through here because the moving average line didn't break, even though it broke down below, it didn't close below. And anyway, opportunity there, opportunity there, opportunity there, another one there, another one there, another one there, another one in here, until finally we go up into here. And then it finally breaks down. Here's 21st of February, which I said is about the day this market suddenly realised things weren't all good with COVID-19. And then we've got a breakdown, and you're definitely out by then. And then you've got this downtrend, and you could have played the 10 and 20 moving average by waiting for it to come down into here and using it as a sell signal. And then, of course, once it came up and the red went over the green, then you can use it as a buy signal when we've got buy signals here and here and here and here. And currently you would be long if you'd used any one of these signals. So again, just looking at the chart, the NASDAQ is super strong. It's within a whisker, as I said before, of its all-time high. It's the strongest of the international equity indexes, and there's plenty of opportunities to go long using this very simple 10 and 30 moving average on a daily chart. Okay, so then knowing that the NASDAQ was the strongest market since March, I am now looking for the strongest financial instrument since March. And of course, the main place I am looking for that is NASDAQ stocks, because as we're about to find, there are some NASDAQ stocks that have gone up much faster than the index. Okay, so here we are. This is the price of the stock on the 21st of February. Remember, I've noticed the 21st of February because that was the day the market really took notice of COVID-19 and started plummeting. In fact, it was more like that was Friday, 21st of February was the last price before the big plummet. So I've taken prices on the 21st of February, and then I've looked at the current price and I've seen what the gain or loss has been. So here is the NASDAQ down here. And as you can see here, since the 21st of February, it's up 2.28%. But some of the stocks within the NASDAQ, like JD.com, like PayPal, Nvidia, Amazon, are way, way higher. So you get a benefit by picking the companies that have done particularly well. And PayPal and Amazon are obvious ones for me. Amazon's done particularly well because people are stuck at home clicking their mouse button and buying stuff, and PayPal's done something is doing particularly well because people are sitting at home and buying stuff, and a lot of those payments are going through the portal PayPal. I've also got them in green because I am currently long those two stocks. So anyway, I saw that the NASDAQ was the best of the equity markets and one of the biggest movers. Then I'm looking within the NASDAQ to see which are the biggest movers. Then I'm trying to take opportunities, looking at the charts and looking at opportunities to see which of those stocks I'm wanting to take. There is a couple of non-stocks in here. Aussie pound is doing pretty well. Gold versus pound is doing well. Gold versus US dollar is doing reasonably well. But I actually quite like playing up in this area here, especially if I've got a reason like I do with PayPal and Amazon, that even if COVID does rear its head again and we get second waves and whatever, these companies will continue to do well, I expect. Okay, so currently I have these positions. I'm long PayPal, I'm long Amazon, I am long Spain index futures only a couple of days ago, and Switzerland index futures. Why these last two? Let me show you the charts and I'll show you why. Okay, so here's the Spanish index, and this is from, I'm showing this chart from June last year. you can see that we've got strong prices, rising prices, rising prices. Here's that 21st of February. After that, the market suddenly gets panicked about COVID and prices get smashed down. Now, one of my favorite trades is an instrument that has been smashed down and then has a period of consolidation, which is exactly what we've got here, and then goes to a new 20-day high. And here's the line that I've drawn, a horizontal line showing support, resistance in this case, but support resistance. And then price breaks up above that level of support and resistance, goes to a new 20 and 55-day high, two of which I like. And the great thing about this trade is I took it on this candle, and my stop is just below this candle at just under 72.70. So it was an incredibly low risk trade when I took it 2 days ago. And well, I've been fortunate. I won't say it's all planning, but my expectation was that, partly because there's so much euphoria about stocks at the moment and relief that things haven't got worse and stimulus and everything else, that stocks are skyrocketing. This was one of the ones that was hammered the most as a bit of relief, and I've got a nice low risk trade with a stop below there, and of course has exploded since I took it, which is nice. Okay, and here is Switzerland. Very similar trade. Price moved up, got hammered during COVID. Not as badly, actually. It's not. You can see it's not nearly as low, but we've got exactly the same thing going on. Nice bit of consolidation, new 20 and 55-day high. There's my entry there, with my stop down below there. Again, as expected, price went up and has been very, very strong. Now, this course, as I think you know, is not a stock picking course. I'm not picking your trades for you. The purpose of this course is to teach you how to pick your own trades. So I wouldn't take this trade now if it was me. If I wasn't already long, the easy money has gone from this trade. Yes, I'm still long. Yes, I still like it, but I've got an incredibly good reward to risk trade on here. So I'm not suggesting that you buy this or Sweden or Switzerland. I'm simply showing you what I do, but if you're looking at lots, if you're looking at 100 instruments regularly, you're going to see these kind of opportunities as well. Okay, so this was the first video of a series of broadcast videos I'm going to be doing over the next week or so. I will update you on my progress, including how I'm going on these trades, and I will talk about another very low risk strategy next week. Happy trading. Let me know what you're seeing on the markets. I'd love to hear. Take care and happy trading.